This is Rod Kusin and Spooman for Risk on May 5th, 2010. All times on the chart are Central Standard Time. We're going to focus on gaps. We have not done a gap video in a while, so here's information that you can put to good use. Our indicators are automatically designed to track gaps on any data feed. A particular data feed where this works quite nicely is the large contract S&P contract SPM10.P. That's the symbol in TradeStation. Now here's the activity for May 5th. We had a gap down, leaving gaps up here at the top of the previous move from yesterday, May 4th. The market gapped down, as we mentioned, rallied all the way back to where the gap was, and proceeded then to move in the opposite direction and look at exactly where these two gap lines were. Market moved all the way down, filled this gap, and then began to retrace, heading back to 1167. That's a pretty good plan for the day. Take a look at the previous day. May 4th was also a gap down. But in this particular case, it moved down to this first gap here, left a gap here, and then rallied back before it proceeded to tank. Now it left several gaps above the market as it moved down to fill this gap. But here again, it moves down, leaves the gap, comes back up, comes back down, and there you have May 4th. Let's go back one more day. Now here was your open. There was a gap that was left from the previous day. Market gap down just a little bit, but came right back up to fill that gap before it began to tank. Several gaps below the market then proceeded to be filled, followed by a brief retracement. Here's another gap filled, followed by a retracement, comes back down, nails that gap and retraces, and so on down the line. April 16th was a very interesting day. We had lots of gaps below the market. Take a look at what happens. Market begins to move down, fills this first gap here, leaves a gap above the market, rallies back up, fills it, comes back down. This gap is filled, this gap is filled, this gap is filled. This gap is filled to the penny and retraces. Comes back down, fills these gaps. Then there's a retracement. Look at where this gap is filled. Then a retracement. Continues to move down. Look at this gap that was left right in here. Right there. That gap. Market moves up, fills the gap, and proceeds to retrace. The frequency that this works is quite high. I've never really calculated it to be certain as to what the probability is, but if you've got a means of calculating or at least capturing gap data, here's a good symbol to do it with, especially if you're trading the S&P. And at the same time, since our indicators are automatically designed to track this gap data, we recommend come and see us at RSKsys.com. Ask for a demo. We've got lots of things to show you. And if you haven't done so in the past, we really recommend that you take a look at some of the things we're doing. We do things that nobody does. And you'll find that the accuracy with which our trading system is designed is quite remarkable. So it's a brief video all about gaps. Gaps are always filled. That's our contention. Gaps are always filled. And oftentimes when they are, you'll see significant retracements, tradable retracements, good high probability trades. So with that thought in mind, I'm Rod Kusin, Spooman. Poor risk.